Every morning at precisely 10 a.m., a specific event takes place in the market. If you can train yourself to recognize it, you have the potential to make a substantial amount of money. Let's take a look at the last 9 trading sessions. You'll see that at exactly 10 a.m. on each of these charts, this method is a powerful tool for generating profits. And I'll even demonstrate its effectiveness by sharing my private backtesting results at the end of this video. Now, let's dive into the details. The core technique we'll be focusing on is called AMD. It's actually quite simple. What you want to see first is price moving sideways or staying within a tight range, which is known as accumulation. Above and below these zones, there will be resting liquidity. This liquidity acts as fuel for a strong market move. The next phase involves a liquidity grab. This is called manipulation. If the market intends to go higher, it first needs to dip lower. Conversely, if the market is headed downward, it will first push upward. After this manipulation phase, price typically makes a strong move in the opposite direction. This is known as distribution. In summary, we have accumulation, manipulation, and distribution, or AMD. If the market is in an uptrend, you'll notice an opening price, followed by a low, then a high. If it's in a downtrend, you'll see an opening, a high, then a low. Recognizing this sequence is essential for anticipating what price is likely to do next. Before we start placing trades, there are a few steps to follow. Step 1, open trading view. Step 2, determine the market bias for the day. To do this, I prefer using the 1-hour chart. It's usually pretty straightforward. If the market is forming higher highs and higher lows, it's trending upward. If it's forming lower highs and lower lows, it's in a downtrend. In this case, we can clearly see that the market is bullish. Now, switch to the 5-minute chart. We are only interested in trades that occur between 10 a.m. and 11:30 a.m. Eastern Time, or 30 minutes after the market opens. To keep track of this, we'll mark the time window with 2 yellow lines. One at 10 a.m. and one at 11:30 a.m. Any trade setup that occurs outside of these yellow lines should be ignored. Since we have a bullish bias today, we're looking for 2 key elements: accumulation followed immediately by manipulation. At exactly 10 a.m., we observe some sideways movement. This is our accumulation phase. So far, so good. Next, we need to see manipulation. Because our market bias is bullish, this manipulation should take the form of a price dip. And that's exactly what happens. Once these 2 conditions are met, it's time to find an optimal entry point. I personally like using a fair value gap for this. A fair value gap is simply a significant price move that leaves a visible gap between the previous candle and the next one. After the price manipulation to the downside, we typically see a strong move upward, leaving a fair value gap behind. We will mark this gap with a rectangle tool. This is our ideal entry point. Wait for the price to retrace back to this gap. Set your stop loss just below the recent low and aim for the previous high as your first take profit target. And just like that, you've got yourself a solid winning trade. But there's a little trick you can use to make your take profit strategy even more effective. To refine our exit strategy, we'll use the Fibonacci retracement tool. Open the settings, go to the Styles tab, and adjust the levels to the following values: 0, 0.79, 0.62, 0, -1, -2, -2.5, and -4. Set all of these values to gray, except for -2 and -2.5, which should be marked in red. Now, let's return to our trade setup. We still have the same conditions: accumulation followed by manipulation. And now price is sitting at our fair value gap. Take your Fibonacci tool and measure from the lowest point of the manipulation, move up to the most recent high. This will provide you with highly accurate take profit levels. The red zone that appears is where you should be looking to take the bulk of your profits. If this red zone aligns with another market confluence, that's even better. In this case, our red zone perfectly matches up with the buy-side liquidity level, making it an ideal exit point. Instead of taking profit at the prior high like before, we now target this red zone, knowing that it aligns with a key factor on a higher time frame. As the trade plays out, we capitalize on the additional profit potential.
I want to let you guys know that I also share trade signals completely for free. For example, just recently, I called that Ethereum was about to break out, and just 2 days later, it shot up nearly 5%. If you want to see more of my trades live, join my free Telegram community, link is in the description. Now, back to the strategy.
If you follow my channel for a while, you know I always test my strategies thoroughly before sharing them. I spend countless hours backtesting to determine whether a strategy is actually profitable, so you don't have to. While you relax and enjoy some snacks, Give this strategy a try and let me know your results. Thanks for watching, and I'll catch you in the next video.